The Investors and the Inflation by Benjamin Graham. Inflation and the first fight against it was been very much in the public mind in recent years. The shrinkage in the purchase power of the dollars in the past, the particulars, the fear, hope of speculators, and serious further decline in the future has generally influenced on thinking that Wall Street. It is clear that those with a fixed dollar income will suffer when the cost of living advances. The same applies to the fixed amount of dollar principal. Holders of stocks, on the other hand, have a possibility that a loss of a dollar purchasing power may be offset by advances in their dividend and the prices of the shares. On the basis of this undeniable facts, many financial authorities have concluded that bonds are inherently undesirable form of investments, and consequently, the common stocks are by their very nature more desirable investment than bonds. We have heard the charitable institution being advised that the portfolio should be consisting 100% of stocks and 0% of bonds. This is a quite and reversal from the earlier days when the trust investments were restricted by law to high grade bonds and the few choices of preferential stocks. Our reader must have enough intelligence to recognize that even high quality stocks cannot be better purchasing than the bonds under all conditions. That is, regardless how high the stock price may be and how low the current dividend return compared to the rate available on bonds. The state available kind would be in absurd so as were the country want to. Too often heard years ago that any bond is safer than any stock. In the chapter, we shall try to apply various measurements to the influential factor in order to reach some conclusions as to content which investors may wisely be influenced by the exceptional regarding the future rising on the price level. In this matter, as if many other in the finance, we must base on the views of public policies on the knowledge of past experience. Is inflation somewhat new of this country, at least in serious forms, in taken 1965? If we have seen the comparable inflation of loss of experience, the lessons has been learned from them and confronting the inflation today. Let us start the table to one. Condensed historical tabulation contains such information about the change of general price level and the concomitant changes. Concomitant. Changes in the market value of the common stocks on figures we began in 1915. Thus, after over 55 years, percent of the 5 years interval, the uses 1964 instead of 1945 to avoid the last year of wartime price controls. First time we noticed that we have had inflation in the past, a lot of it. The largest 5 year rose on the between 1915 and 1920 when the cost of living nearly doubled. The compares with the advance of 15% between 1965 and 1970. In between, we have had 3 years of declining prices. Then six of advances of varying rates, some rather small. On the following, the investor should really allow the probability of continuing or recruiting inflation to come. We can tell about the rate of inflation is likely to be clear answer in suggestion or table. It shows variation of all sort. It would seem sensible, however, it take our cue about the rather consistent record of past 20 years. The average annual rate of consumer price level price. It has been 2.5%. 1965, 1970 is 4.5, 1970 around is 5.4. Official government policy has been strongly against the large scale inflation, and there are some reason to believe that federal policies will be more effective in the future than the recent years. We think it would be reasonable for the investor at the point to be to base his investment and decline on the probable for the certain rate of future inflation and 38% RM. This would compare with the annual rate about 2.5% for the either period of 1950 to 1970. Table 2.1 General price levels, stock owning and stock prices. 5 years interval 1915 to 1917. Price level S&P stock index, wholesale consumer stock or wholesale prices, consumer prices, stock earning and stock prices. 1915 wholesale price level wholesale 38, consumer 35, price is 3.5, index by 8.5. Okay. 5 years, 38 become 84. But consumer is it's 15%. Price is 7%. Wholesale 96% increase for consumer. And then 56, 61, it's 11. So you see the pattern 8, 7, 11, 21, 15, then down 11, then increase 17, then increase 18, then increase to 40, then increase to 55, then increase to 88, then 92. It is the S&P is increasing constantly. At the same time, earning 1.24, zero point 0.9 down, 0.76 down, then increase to zero point 0.1, then increase to 1.06, then 2.84, then 3.6, then 3.2 down, then 5.19 increases, and 5.36 increases. Earning is also increasing. Our consumer prices and wholesale prices you see here. The consumer by 84, 56 down, 47 down, then 43 down, then 43 down, for 66 sudden increase, 96, 97, 100, 102, 117. Yes. Consumer prices also saying increase away. But using some base 1967 100, the average of 1971 160 for consumer prices and 1.6 whole prices for the stock index. 1941 to 1943 average 10 and 1946 used to avoid price control. That would be an implementation of such advance. It would set up in the higher or living cost about the half of the income now obtained on the good medium tax-free bonds on as a assumed after tax evidence from the high rate corporate bond. This would be seriously shrinkage, but it would not be exaggerated. It would not mean the true value of the purchasing power of the investor's fortune need to be reduced. Or yes, if we spend half of the interest in income and over after taxes, he shall maintain the buying power intact even against 3% annual inflation. But the next question actually is, can the investor be reasonable, sure of doing better by buying and holding such others on high grade bonds, even unpredictable rate of return? Of 1970 to 1971 would not. For example, all stock program to prefer to be it's a part bond, pot stock program. Do not common stock have a built-in protection against inflation? And there are smart moves attain to give up certain returns over the years in the bonds. Have not the fact stocks treated as investor far better than having bonds over 55 years period of our studies? Answer to this question is somewhat complicated. The common stocks have indeed done better than the bonds over the long period of time in the year. The rise of DJIA from the average of 77 to 1915 and the average of 1753 1970 works out the annual component rate of such about 40%. It was in which to you may add 4% average dividend. The corresponding figures of S&P companies are about the same. The combined figure of 8% per year are the was better than the return enjoyed after the bond of frame 55 years old, but they do not exceed the now offered high grade bond. That brings us to the next local question. Archel question. Is there a presumptive reason to believe that the common stocks are likely to much better in the future year that they have the last 5 and 1/2 decent 1/2 decades? Our answer is to the crucial question. Maybe the flat no. Common stocks may do better in the future than the past, but they are far after certain to do so. We may deal with the two different time elements of the investing sector. The first cover is likely to occur over the long term future say. Next 25 years, the second applies to what is likely to happen to the investor both financially and psychologically over the short term intermediate period. Since the 5 years his frame of mind, its hopes and appreciation is satisfied or discontent with what has done. Above all the decision, what to do. Next, all that determine, all are not determined not to retrospect the lifetime of investment, but rather but experience from the idea. On this point, we can be categorical. There is no close time connection between the inflammation and deflation. Condition in the movement of common stock earnings and prices. Obviously, is an example of the recent price 1966 to 1970. The rise of the cost of living so 22%, the largest of the 5 year period since 1947 to 1915. But both stocks earnings and stock prices as a whole were declined since 1965. A similar contraction, but both the directions in the record of previous 5 year period. Another highly important approach to subject to the study of earning rate and capital show American business. This has fluctuation, of course, which is a general rate of economic activity, but is also shown as a non general tendency of advance in wholesale prices or the cost of living. Actually, the rate has fallen rather markedly in the past 20 years in spite of inflation of the prior year. To some degree, that a decline may due to the charging of more deliberate depreciation rates. Our extended study had led to the conclusion that the investor cannot count as much above the recent 5 years rate earned on the DGIA groups, about 10% of the net tangible assets book value behind the share. Since the market value of this shows well on the bond book value. Phase 900 market is 560 books in mid 1971. The earning on the current market price works out only at the same of 61 to 4 percentage. The 61.4 percentage, 61.25 percentage. The relationship is generally expressed in the reverse as the times earning the manner that is the DGIA price is 900 equal to 18 times the actual earning of the 12 months since 1971. Our figures gear the directly with the suggestion that the previous chapter that the investor may assume the average dividend returns of about 3.5% of the market value of the stocks plus on the appreciation say 4% of annual resulting from the reinvestment profits. Note that each dollar added to the book value is here assumed to be increasing the market price of about 1.6%. Reader will object that the end of our calculation make no allowance that the increase in the common stock earnings and the values in result from our project 3% annual inflation. Our justification is the absence of any sign of inflation on the comparable amount in the past that has a direct effect on reported per year earning. The cold figures demonstrate that all the large gains in the earnings of DJIA unit in the past 20 years was done to the approximately large growth of investor capital comes from reinvested profits. If inflation has operated as an reasonable favor factor, the effect would have been increase the value of the previous existing capital. This turn should be increase the rate of earning on such a old capital and therefore on the old and new capital combined. But nothing of the actual kind happened in past 20 years, during which the wholesale price level has advancedly nearly 40%. Business earnings should be influenced more by the wholesale price than by consumer price. The only way the inflation can add to the common stock value is by raising the rate of earning on the capital investment. On the basis of past record, has been the case. The economic cyclist of the past good business was accumulated by the rising price level and poor business by falling prices. It was generally felt that a little inflation has helped to the business profit. This view is not contradicted by the history of 1950 to 1970. It is revealed the combination of gentle continued perspective and gently rising prices. But the figures indicate that the effect of all this is the earning power of common stock capital has been quite limited. In the fact, it has not even served to maintain the rate of earning on the investment. Clearly, there have been important offsetting to influence which has prevented any increase in real profitability of American corporations as a whole. Perhaps the most important this has been the rise in wages rate exceeding the gain in productivity, or the need for a huge amount of new capital, thus holding down the ratio of sales to capital and capital employed. On figures indicate that so far our inflation have benefited our corporation and the shareholder. Its effect has been quite opposite. The most striking figure is our table. Those are growth of corporate debts between 1950 to 1969. It is surprising how little attention has been paid by the economists and by the Wall Street to development. The depth of the corporations are expected nearly fivefold, where the profits has been taxed in the little amount than the document. This is a good, this great rise in interest rates during the period is evidence that the aggregate corporate debt is now an adverse economic factor of some magnitude and a real problem for many in the individual enterprises. Note that 1915 net earning after interest but before the income tax were about 30% of corporate debt, while in 1969 they were 113.2% of debt. In 1970 the ratio must have been very less satisfactory. It somewhat appears that significant part of 11% being earned from corporate equities as a whole and accumulated, but by the use of large amount of new debts. I guess for costing 4 percentage or less after the tax credit. If our corporation has maintained the debt ratio of 1950, the earning rate on stock capital would have fallen still lower in spite of the inflation. Corporate debt profit earning on capital 1950 to 1969. So here debt, tax after tax, and percentage of earning and okay, other data. Debt to 140, income before tax 42, after 70, 48, 27, 14, okay, 30% tax is paid. But the net debt is increasing constantly, it's increasing, right? Because after tax and after interest also, that is eating the profit. Owning on Standard and Poor Industrial Index dividend by average book value of the year. Because 1950 to 1955 was the quarter and it meant those 1960 and 1916 have the fortune. In the stock market have considered that public utility enterprises has been a chief facility of inflation, being caught between the great evidence in the cost of borrowing money and the difficulty in raising the rates charge under the regulated process. But this may be the place of remark that every fact the unit cost of electricity and gas telephone service has been advanced so much less than the global price index puts these companies in strong strategic position for the future. They are entitled by the law to change the rates sufficient for an adequate return on its invested capital, and this will probably protect the shareholders in the future as it has inflation in the past. All the above brings us back our conclusion that the investor has no sound basis for expecting more than average overall return. Say 8% of portfolio of DJI type of common stocks purchased later 1957, 1971 profit level. But even this expectation was proved to be unsustainable by the substantial amount. This case would not be made with the all stock investment program. If there are one thing guaranteed for the future, it is the earning and the average annual market value of stock portfolio will not grow at the uniform rate of 4% for any of these figures. In the memorable word of this elder J.P. Morgan, they will fluctuate. This means the common stock buyer at a today's price or tomorrow will be running a real risk of having a satisfactory result of thereafter over a period of years. It took 25 years for the General Electric and to recover the ground lost in 1920 1932 database. Besides that, if the investor concentrates its portfolio on common stocks, is very likely to be led astray either by an exhibitory advances or by distressing decline. This is particularly true if the reasoning is geared closely to expectation of further inflation. Further, it is another bull market comes along, he will take the price rise, not the danger signal or the inevitable fall, not in the chance to cash in the homes and profit, but rather as a vindication of the inflation hypothesis, and so the reason to keep them buying common stocks, no matter how the high market level, now how the low the dividend return, they will lie sorrow. Alternative common stocks is inflation hedges. The standard policy of people all over the world who mistrust their currencies has been to buy and hold the gold. This has been against the law of American citizen 1935. Luckily for them, in the past 35 years, the price of gold is open market has advanced from $35 to $48 in 1970, a rise of 35%. But during all this time, the holder of gold has received no income return on the capital and instead has incurred some annual expenses for storage. Obviously, he would have done much better with the money and at interest in a savings account, in spite of the rise of gentle price level. The near complete failure of gold to protect against a loss in the purchasing power of dollars must cast grave doubt in the ability of ordinary investor to protect them against inflation. But putting this gold in things, the quite a few categories of valuable objects have been striking advantages of market value over these years, such as a diamond painting of masters, first edition of books, rare stamps and coins. But in many, perhaps most of these cases seem to be element of artificial precious or even unreal about the quoted price. Somehow, hard to think paying $60, $67,500 of US or silver dollar dated in 1804, but not even minted that year. As the investment operation, we acknowledge that we are out of the depth in the area. Very few of the readers will find that swimming safe and easy though. Outright ownership of real estate have been considered as a sound long-term investment, carrying with a goodly amount of protection against inflation. Unfortunately, real estate values are also subject to wide fluctuation, serious error, and can be made in one location. The price paid, etc. There are pitfalls in the salesman's voice. Finally, a diversification is not particular for the investor of moderate means, except by the various type of participation with others, with the special hazards that attract a new rotation. Not too different from the common stock ownership. It is not our field. All we would say to invest in an invest to be the investor. Yes, be sure it's yours before you go into it. Be sure it's yours before you go into it. Conclusion. Naturally, we return to the policy recommended our previous chapter just because of uncertainties of the future. The investor can afford to put all these funds into one basket, neither in the bond basket, despite the unpredicting high returns that bonds have recently offered, nor the stock basket, despite on the prospect of the continuing inflation. More the investor depends on the portfolio and the income, therefore, the more necessary it is being a guard against the unexcised and disconcerted in the past of the life. It is an axiomatic, this is conservative investor about seek to minimize the risk. We think strongly that the risk involved in buying says a telephone company bonds yields nearly 7.5%, or much less than those involved buying DJI at 900 or any stocks equivalent therefore. But the possibility of large scale inflation remains, the investor must carry some insurance against it. There is no certainty that the stock component will ensure adequate against such inflation, but it should carry more protected than the bond component. This is what we say is a subject in our 1985 edition, and we should write the same today. It must be evidence to the reader that we have no enthusiasm for common stocks at this level. And for a reason already given, we feel that the defective investor cannot afford to be without an appreciable proportion of common stocks in the portfolio, even if we regret that as the lesser of two evils, the greater being the risk of all bond holding.